So I think we've got a 4-week window that is really scary. Something between 2 and 5 weeks, call it that is going to be really scary. And I think once the month-end rebalance finishes, it probably goes lower, and crypto's kind of telling us where the natural state of affairs is.
What do you make of the inflation picture and the consequences for the Federal Reserve when you watch these data prints out today?
Yeah, look, I agree with you, and I've been following what you've been saying on Twitter. Look, I think the inflation peak is in. Just the year-on-year comps, let alone structural inflation. I think the year-on-year comps are going to be, we'll see inflation come down pretty sharply. Now, I also think there's massive demand destruction going on in the economy too. When I look at monetary conditions, not just using the Goldman Sachs index, but if I add in, so if I use it, the rate of change of mortgages, 2-year rates, oil, gasoline, and the dollar, that's the largest monetary tightening in all recorded history that's underway. And I put a piece out on Real Vision today that should come out shortly about some of this stuff. And I think we have the potential to set up to see negative inflation next year. I think the one thing that needs to happen for that to occur is for crude oil to fall. It doesn't have to fall a lot, but then the year-on-year comps by March of next year, crude oil is going to be a massive negative year-on-year. So, and that's not going against the crude oil story, which is the structural supply issue. It only has to trade lower for a period of time down to $70, $80. And before you know it, the inflation number absolutely collapses.
Is whether the Fed will be more hesitant in pivoting due to the fact that we are still running clearly above the inflation target. So what do you make of that discussion?
Yeah, so this came up at the round table. There's a narrative which is, well, if inflation's still high, we need to see it coming down to 3% or whatever before they do anything. So I went back and checked every time in history. That never happens. In 2001, they were cutting all the way through from oil going from $100 to $140. 2018, they were cutting. They paused and had cut with the oil price coming up. Most of these examples, when you go back, even in the 1970s, inflation was still going up and oil was still going up while they were cutting. And in 1974, they were cutting from about July, and really inflation didn't roll over till early the next year. So I think it's a red herring. I think they will focus on inflation, but they realize that demand is the bigger driver. And as soon as demand starts to showing that it's coming down, i.e. the economy starts shrinking or heading that way, that's when they pivot. And that was 2018 in a nutshell. ISM touched 50 and they stopped.
Can you maybe walk us through your thoughts on demographics going 3-5 years forward?
Yeah, so if I look at the demographics of Europe and the US, but let's focus on the US. The baby boom cohort is average age of 70 now. So some of them are in the workforce, particularly in part-time jobs. There's some in full-time jobs in the workforce. They're coming out of the workforce and they have to go into retirement. So firstly, retirees tend to own more bonds than equities because you don't want your pension falling 50% in a recession. Secondly, if you don't know how long you're going to live for and you've got a fixed amount of capital, you tend to be careful in how much you spend. I've seen my parents go through this when they retired. Their spending went down a lot. So the consumption of that cohort goes down, but they're also saddled with debt. So that dynamic tends to create lower growth. And I look at the labor force participation rate and you can extrapolate it going forwards. And basically it's the trend of GDP, it's the trend of inflation, it's the trend of velocity of money. It's the trend of pretty much everything of our economic lifetimes. And it's driven by this old cohort. And so that means that it's almost impossible to generate inflation for extended periods of time.
What do you make of the current situation in China and the spillovers to potential growth in the Western world, both short term and also over the medium term?
Yeah, look, China cannot be a driver of economic growth in the way that it was in the past. You know, we think of, like you talked about the 1970s, there was a double demand shock of everybody hitting 30 at the same time, buying their first house, first car, having their first kid, all of that stuff, and women coming into the labor force, right? It was the biggest demand shock in history. China came onto the world stage and globalized. Massive demand shock for the economy. It was great. They rebuilt the economy. But the problem is with an aging population now, your trend rate of growth collapses. And they know it. Now, you can try and use technology to offset it, but it's yet to be seen whether we can do it because nobody's done it at scale. Japan's not managed it yet, and they're probably the world leader in robotics. But that's what you need. You need a robot workforce if you want to raise productivity per capita if you don't have many people.
The question here is whether duration-linked equities will finally catch a bid as a result of that. What do you make of that discussion?
I have been buying I've been averaging in over time the growth long end of tech because I believe that the tech adoption of AI, robotics, EV, everything is exponential in nature, and therefore you want to be involved in the secular trends. I like trading with the secular trend and not against it. And a lot of this stuff is down 75%. So I'm starting to think, this is interesting because if inflation comes lower and rates come lower, they should perform really well. And there's some crazy valuations, stuff like Coinbase trades for nothing these days. And, it basically needs to make one decision, which is, does digital asset network adoption continue or not? And if it continues, then it's wildly underpriced because these things are logarithmic trends. So there's a lot of stuff like that out there right now that's really interesting.
One thing that we haven't touched upon yet is the dollar. We've got a question here on the DXY, so the broad dollar index, and it has actually been trading down over the past week here, despite Nasdaq rallying, for example. So what do you make of that? Is the dollar sort of decoupling from the development in US equities, and what's happening here?
So, I was lucky to catch all of the dollar move. I saw that coming, and then I actually took profits last week. I think it was last week. Because just technical basis. But what I've figured that as bond yields top out, the kind of lazy trade is to say, oh, bond yields down, therefore dollar down. That is a passing correlation, right? The dollar's really Bayesian, so it kind of shifts around what affects it all the time. So I figured, okay, we might see a bit of a washout now. I think as bond yields come down, the Japanese stop buying as many bonds, and therefore it stops recycling it into the US bond market. So the dollar therefore backs off somewhat.
A final part of this question related to the dollar also referred to the developments that we've seen in Ethereum and Bitcoin this week, because it's kind of an interesting divergence that we have tech stocks rallying while we still see another drawdown in Ethereum and Bitcoin. Do you have any explanation of this divergence, Raoul?
Yeah, it's month-end rebalance. Right, the risk off and the elements of liquidity tightness and people needing to sell assets to realize capital is still playing out in crypto. And I think it goes further. I think we've got a 4-week window that is really scary. Something between 2 and 5 weeks, call it that is going to be really scary. And I think once the month-end rebalance finishes, it probably goes lower, and crypto's kind of telling us where the natural state of affairs is. I think it's also interesting that bond yields, keep coming down while equities kind of rallied. Normally, as equities rally, you'd be saying, well, the probability of the Fed needing to do something goes down. So, yeah, I think it's written in the language of the market somewhere that risk still has to come lower first.